Barbara is 67 years old. After spending 28 years working at the post office, she retired and now lives in Ohio on a combination of pension income and Social Security. Every April, she follows the same routine. She hands her paperwork to the same tax preparer she has trusted for more than a decade, pays whatever amount she is told she owes, and moves on. Last year, that number was $900 in federal income tax. But here's the problem. She should have owed zero. Not because she made a mistake, not because she was doing anything dishonest, but because there are multiple provisions built directly into the tax code that are specifically designed to protect people in her situation, and not a single one of them was applied to her return. Her preparer never brought them up. The IRS never flagged anything. And like millions of retirees over the age of 65, Barbara had no idea she was leaving real money behind, year after year. Today, I'm going to walk you through all 5 of these tax breaks. This video is for educational purposes only and should not be considered tax or financial advice. Always speak with a qualified professional before making decisions about your personal situation. Welcome to GoldenAge Benefits. My name is Ali, and every week I break down tax rules, financial pitfalls, and simple strategies that help retirees avoid costly mistakes that most people never hear about. If that sounds helpful, make sure to subscribe and turn on notifications so you never miss an update. Now here's what makes this list different. These are not advanced strategies for wealthy investors. These are not complicated loopholes. These are straightforward tax breaks built for everyday retirees, many of them automatic once you know where to look. And yet, they are missing from a surprising number of tax returns. Let's start with tax break number 1. The additional standard deduction for those age 65 and older. This is one of the simplest benefits in the entire tax code and one of the most commonly overlooked. Once you turn 65, the IRS increases your standard deduction on top of the base amount everyone receives. For the 2026 tax year, that additional deduction is $250 for single filers and $1,650 per qualifying spouse for married couples filing jointly. If both spouses are 65 or older, that adds up to an extra $3,300. In many cases, this is applied automatically when your age is entered correctly, but you would be surprised how often the age box is left unchecked, especially when someone switches preparers, uses new software, or files in a hurry. Here's something even fewer people realize. If you are legally blind, you qualify for an additional increase as well. And if you are both 65 and legally blind, those two benefits stack. That means a single filer could receive an extra $4,100 added to their standard deduction. I have personally seen cases where that box was never selected, even when the individual had a documented visual impairment. Now let's move to tax break number 2, the senior bonus deduction. This one is brand new, and many preparers are still not applying it correctly. A law passed on July 4, 2025, introduced a new deduction specifically for taxpayers aged 65 and older. It's called the senior bonus deduction. Eligible individuals can deduct an additional $6,000 from their taxable income. For married couples where both spouses qualify, that number doubles to $12,000. What makes this deduction especially valuable is that it applies whether you take the standard deduction or itemize. That's important because most retirees do not itemize. There are income limits, $75,000 for single filers and $150,000 for married couples filing jointly. Below those thresholds, you receive the full benefit. Above them, it gradually phases out. This deduction is claimed on a new Schedule 1A attached to your Form 1040 or 1040 SR. It is only available from 2025 through 2028. Now let's look at how powerful these first 2 breaks can be together. Imagine a married couple, both age 66, living on Social Security and a modest pension with about $80,000 in income. Their base standard deduction for 2026 is $32,200. Add the extra senior deduction of $3,300. Then add the new bonus deduction of $12,000. That brings their total deduction to $47,500 before any income is taxed. For many retirees, that could eliminate most, or even all, of their federal tax liability. And yet, because this rule is so new, even the IRS has acknowledged that some tax software may not apply it automatically. If you already filed without claiming it, you may still be able to amend your return within 3 years using Form 1040X. Now let's move to tax break number 3. The Qualified Charitable Distribution, or QCD. This is not a deduction, it's something even better. If you are age 70 and a half or older and have a traditional IRA, you can transfer money directly from your IRA to a qualified charity. Because the funds go straight from the account to the charity, they are not counted as taxable income. That means they do not increase your adjusted gross income. They do not cause more of your Social Security to become taxable, and they do not trigger higher Medicare premiums later on. For 2026, you can transfer up to $111,000 per person this way. And importantly, this distribution can count toward your required minimum distribution for the year. Here's a simple example. Carol is 74 and must withdraw about $14,000 this year as her required minimum distribution. She also donates $2,000 annually to her church. If she withdraws the full amount and then donates, the entire $14,000 is taxed. But if she sends $2,000 directly from her IRA to the church, that amount is excluded from her taxable income. She still satisfies part of her required distribution, but her taxable income drops. The result is real savings. The key is timing. Once you withdraw the money into your own account, it becomes taxable. The transfer must go directly from the IRA custodian to the charity, and the deadline is December 31st, not April 15th. Now let's look at tax break number 4, the medical expense deduction. Retirees are more likely than any other group to qualify for this, but many assume they do not. If your unreimbursed medical expenses exceed 7.5% of your adjusted gross income, you can deduct the portion above that threshold if you itemize. Eligible expenses include Medicare premiums, supplemental insurance, prescriptions, dental care, hearing aids, vision care, and even certain home modifications made for medical needs. For retirees, these costs add up quickly. Even moderate medical spending can push you past that 7.5% threshold. The mistake many people make is assuming the standard deduction is always better. But in years with higher medical expenses, itemizing can provide greater savings. Finally, tax break number 5, the credit for the elderly or disabled. This is one of the most overlooked credits in the entire tax system. If you are 65 or older, or under 65 with qualifying disability income, you may be eligible for a tax credit ranging from $3,750 to $7,500. Unlike deductions, credits reduce your tax bill dollar for dollar. The challenge is that income limits apply, and they are relatively low. However, many retirees still fall within those ranges, especially those living on modest pensions and Social Security. This credit is calculated on Schedule R and then applied to your return. In many cases, it can eliminate your tax bill entirely. Now let's bring everything together. Barbara's return was missing multiple benefits: the additional senior deduction, the new bonus deduction, and medical expenses that could have changed her filing strategy. Once those were addressed, she filed an amended return and received $840 back. Nothing complicated, just information that was overlooked. And that's the real difference. It's not about wealth, it's about awareness. Here's your action checklist. Review your recent tax return. Confirm your age-related deductions were applied. Check for the senior bonus deduction if you qualify. If you donate to charity and have an IRA, explore QCDs before your next distribution. Add up your medical expenses and compare them against your income. And if your income is within range, ask about the credit for the elderly or disabled. If your preparer cannot explain these, it may be time to find someone who can. This is GoldenAge Benefits. If you found this helpful, make sure to like, subscribe, and share it with someone who might be missing these same opportunities. And let me know in the comments, which of these surprised you the most?